Welcome everyone, and thank you for joining me today. I'm excited to introduce our presentation on the Precision Trading Framework. Today, we'll be exploring how institutional price levels, higher timeframe smart money logic, and points of interest come together to create a powerful approach to trading. Over the next few slides, we'll delve into the synergy between higher timeframe liquidity and key levels within the smart money concept. My goal is to give you a solid framework to help improve your trading precision. So, let's get started. Let's dive into why liquidity is such a vital concept in the market. Whenever stops exist, those points where traders have placed their stop-loss orders, institutions see these as strategic areas to target. They essentially aim to fill their orders in these zones, making liquidity the engine that really drives market movement. Think of liquidity as the fuel powering the entire market engine. Price tends to move toward these liquidity zones by design. It's almost like a magnetic pull. Large players know where the liquidity is, and the market naturally gravitates toward those spots. Institutions need this liquidity to enter or exit large trades without causing too much disruption. Without enough liquidity, their big trades could cause wild price swings or slippage. In the context of the smart money concept, or SMC, liquidity specifically refers to clusters of stop-loss orders, which are often placed by retail traders and smaller institutions. These clusters are crucial because large institutions require a substantial amount of liquidity to execute their big moves smoothly. If they tried to do so without enough liquidity, the market could become volatile or unpredictable. So, in essence, understanding where the liquidity clusters are, these areas of stop-loss orders, gives us insight into where the market might move next. It's a key piece of the puzzle in deciphering the actions of smart money and understanding market dynamics at a deeper level. On slide 3, we're diving into the concept of these major levels that consistently attract institutional price delivery. What does that mean? Well, these levels tend to draw in a lot of order activity because they represent areas where institutional traders have placed significant bets. They act like magnets for price because of the concentration of buy and sell orders around them. Now, these historical levels are crucial because they often serve as liquidity zones. Think of them as hotspots where institutions can manipulate the price or fulfill their large orders without causing too much market impact. They are key to understanding how the market moves and where the big players are likely to act. Moving on, we look at previous daily and weekly highs and lows. These points are important because price often reacts around them. For instance, it might break a trend line that has accumulated stop-loss orders just above or below these levels. When those stop-losses get triggered, it can lead to sharp, rapid moves, kind of like a domino effect. Next, let's talk about trendline liquidity. Trend lines aren't just lines on a chart. They often mark areas where liquidity is gathered. When price approaches these trend lines, it might trigger stop-loss orders, causing sudden moves that can be exploited by institutions. Now, on the flip side, equal lows are equally important. They indicate sell-side liquidity, meaning traders have placed stop-loss orders at these levels. When price dips to these points, it can be pulled downward to trigger those stops, creating entry opportunities for the big players who want to push the market in a certain direction. Similarly, equal highs represent buy-side liquidity. These levels are potential targets for a price sweep, where the market pushes up to clear out existing buy stops before reversing or continuing its trend. Recognizing these levels helps us anticipate where the market might head next. Finally, all of this ties back to understanding major higher timeframe liquidity pools. These are the big zones that institutional traders pay attention to. Grasping where these liquidity pools are located on higher timeframes is crucial because they influence the overall market structure and help us anticipate where price might go next. So, in essence, understanding these levels, whether they're highs, lows, trend lines, or liquidity zones, is vital for predicting institutional price delivery and making smarter trading decisions. It's important to remember that points of interest, or POIs, are not just random levels to enter blindly. Instead, they are specific areas where we expect the market to react or reverse, making confirmation essential before taking action. Now, within these POIs, we have key levels known as premium and discount areas. These are the price zones within a trading range that suggest favorable points for buying or selling. Think of them as strategic zones where the market offers the best opportunities. We also look at liquidity zones, which are areas where significant buy or sell orders tend to cluster. These zones often serve as magnets for price movement because large traders and institutions place their orders there, creating potential turning points. Another concept is the fair value gaps, or FVGs. These are inefficiencies or gaps in price delivery that often attract the market back to fill them. Recognizing these gaps helps us anticipate potential support or resistance levels. Order blocks are also crucial. They are candlestick patterns that indicate where institutions have placed large orders. These blocks often act as strong support or resistance zones, given the size of the orders behind them. Finally, understanding key higher time frame POIs is vital. These are the institutional reaction zones on larger charts where the market is highly likely to respond or reverse. So, in summary, POIs are precisely identified areas based on specific market phenomena, not arbitrary levels. They help us make more informed trading decisions by highlighting where institutions and large players are likely to react. Let's talk about how identifying these characteristics can really help you filter out weaker points of interest, or POIs. When we do this, we focus on setups that have a higher probability of success, which ultimately increases the accuracy of our trading decisions. One key indicator is when price leaves the POI without any significant retracements. This suggests strong institutional intent behind the move, showing that big players are pushing the price in a decisive manner. We call this a clean price departure, and it's a sign that the move might be more reliable. Another important point is evidence of liquidity being swept before the POI initiates a powerful move. For example, if you see stop losses getting taken out right before an acceleration, it indicates that institutions are clearing out weaker orders and setting the stage for their next move. This is what we mean by liquidity taken before the move. Large, aggressive candles moving away from the POI are also a telltale sign. These strong displacement candles reflect conviction from institutional traders. They're moving decisively, not just messing around. When you see these, it's a good indication of a genuine institutional move. Additionally, a clear break of previous highs or lows, known as a break of structure, signals a shift in market control. This break confirms that the market is transitioning into a new phase, often driven by institutional activity. Now, it's important to remember that not all POIs are created equal. High probability, higher timeframe POIs, or HTF POIs, tend to exhibit specific characteristics. These traits are what make them more reliable and worth paying close attention to. Recognizing these high-quality zones can significantly improve your trading edge. So, by understanding and spotting these characteristics, you can better identify the most promising POIs and align your trades with institutional activity, increasing your chances of success. Let's dive into how adhering to this principle helps us filter out bad trades and better align our entries with institutional order flow. The key idea here is to only sell when the price is above the equilibrium, which is the premium zone, and only buy when it's below the equilibrium, the discount zone. The 50% equilibrium of the higher timeframe range acts as our critical dividing line. Think of it as the midpoint that separates the zones where institutions prefer to buy from where they prefer to sell. Institutions tend to sell only in the premium zones. That's the upper half of the range, because they want to sell high and buy low. Conversely, they buy only in the discount zones or the lower half, because they want to buy at a lower price and sell at a higher price later. Understanding this premium and discount concept is fundamental to institutional trading. It helps us identify the most optimal entry and exit points within a given range, aligning our trades with the way large players operate. By applying these rules, we're not just guessing. We're trading in harmony with the big players, which significantly improves our chances for success. Let's take a closer look at this sequence, which defines the smart money entry zone, where the footprints of institutional traders are most clearly visible. From the point of interest, or POI, price action can go two ways. It either reverses direction or it continues its current trend with a renewed burst of momentum. This is crucial because it shows how the market responds after reaching a key level. When the market sweeps liquidity, meaning it moves through areas where stop-loss orders are clustered, it then moves toward a higher time frame, or HTF, point of interest. These could be order blocks, fair value gaps, or other significant levels where institutional orders are likely pending. At these HTF POIs, the price tends to react strongly. It either stalls, reverses, or accelerates, giving us clues about the intentions of the smart money. When price sweeps through liquidity pools, it triggers stop orders placed by retail traders, and this activity provides the volume needed for institutions to execute their larger orders without causing excessive market impact. Markets are inherently designed to seek out areas where stop losses are concentrated. This makes sense because institutions want to facilitate their large orders without pushing the market against themselves. So, they target these liquidity zones to efficiently fill their positions. Ultimately, the goal is for price to reach these HTF liquidity levels, where the interplay between liquidity and POIs forms the core of institutional price action. Recognizing this dynamic helps us understand where smart money might be entering or exiting the market. By understanding how liquidity and POIs work together, we gain a clearer picture of the underlying forces driving market movements. This knowledge is essential for aligning our entries with the intentions of the major players and improving our trading edge. The HTF, or higher time frame, provides the overarching direction for our trades, setting the big picture context. Meanwhile, the LTF, or lower time frame, is where we focus on the precise execution point, allowing us to maximize accuracy and better manage our risk. When entering a trade, I look for a refined OB or fair value gap within the LTF MSS. This helps me pinpoint a smaller, more precise entry zone within the larger context. Next, I want to identify a market structure shift, or MSS. This is a clear break in the market structure on the LTF, signaling that the immediate trend might be changing. Recognizing this shift is crucial for timing our entries effectively. Then, I wait for a liquidity sweep, essentially, a final liquidity grab near the HTF point of interest. This often indicates a potential reversal or continuation point, giving us a more confident entry signal. Once I see that, I drop down to a smaller time frame, like a 15-minute or 5-minute chart. This allows for a more detailed and precise observation of price action. The key is that once the price arrives at a critical HTF point of interest, I shift my focus to the lower timeframes. This transition from HTF to LTF is where I look for exact entry signals, ensuring I execute at the most opportune moment. Remember, institutions are patient, traders must be too, adhering strictly to the structured SMC methodology. It's crucial not to confuse SMC principles with traditional retail indicators, which can often give conflicting signals and lead to poor outcomes. Mixing retail concepts with SMC is a common mistake that can cause traders to buy in premium or sell in discount zones, essentially going against the institutional flow and increasing risk. Ignoring the importance of premium and discount zones can be costly. Entering trades without waiting for lower timeframe confirmation, assuming that the higher timeframe point of interest will always hold, is a risky approach. Blind entries at higher timeframe zones, without proper confirmation, can lead to unnecessary losses. Another key mistake is cluttering charts with too many points of interest, which only creates confusion and indecision. Focus on high-quality zones instead of trying to mark every possible point. Also, trading solely based on lower timeframe signals without considering the bigger picture or the liquidity on higher timeframes can cause you to miss important institutional traps and opportunities. Even experienced traders can fall into these common pitfalls if they don't maintain discipline when applying smart money concepts. Staying disciplined and understanding these key principles is essential to avoid these mistakes and to improve your overall trading success. Let's walk through the final slide of our presentation, focusing on the key steps for executing a trade where institutions are actively participating. First, before we even consider entering a trade, it's crucial to thoroughly review our HTF liquidity and POI checklist. This step ensures that our setup aligns with institutional principles and reduces unnecessary risk. Next, identify potential liquidity pools that the market might be targeting, which can give us insight into where price could move next. Once we've pinpointed those, look for high-quality points of interest such as order blocks or fair value gaps on the higher time frame, as these are often the zones where institutional activity is concentrated. Then, confirm that the market is in a state of liquidity sweep, meaning that recent liquidity has been taken, fueling the move from our POI. This liquidity sweep is a sign that institutions might be shifting control, setting the stage for the next move. After that, look for a market structure shift, or MSS, on a lower time frame, which indicates a potential change in trend direction. If you see a refined entry opportunity on a lower time frame, that's a good sign to consider entering, especially if you have LTF confirmation. Importantly, always ensure your trade direction aligns with the zone we're trading in, whether it's a premium zone for selling or a discount zone for buying. This alignment helps improve the probability of success. Finally, and most critically, implement proper stop-loss placement and determine your position size before entering the trade. Managing your risk properly is essential for sustainable trading. By following this structured checklist, you align your trades with institutional behavior, which significantly increases your chances of success.